Global markets are trading with a more defensive tone as we move through Tuesday, with the macro narrative once again dominated by the intersection of geopolitics, energy, and inflation. The key driver over the past 24 hours has been a renewed deterioration in sentiment around the US Iran situation, with rhetoric hardening and expectations for near term resolution fading. As a result, oil prices have remained firm and the geopolitical risk premium has reasserted itself, feeding directly into inflation expectations and supporting the US dollar. Gold is holding up well, reflecting continued demand for hedges against both geopolitical uncertainty and inflation risk. On the equity side, the tone is more cautious after the recent push to record highs. U.S. equity futures are softer as investors reassess valuations in the context of rising oil prices and the risk that inflation pressures could persist for longer. The earlier rally had been built on easing yields and improving sentiment, but the dynamic is now being challenged as energy markets tighten again. Globally, equity performance is more mixed, with signs of profit taking emerging in some markets after strong gains, particularly where valuations have become more stretched. Looking ahead, all eyes turn to the US CPI report due later today, which is expected to show a pickup in inflation, driven in part by higher energy costs. This release will be critical in shaping expectations for the Federal Reserve's policy path, particularly as markets push out the timing of any potential rate cuts. The broader takeaway is that markets are shifting back into a more cautious, headline driven environment where direction is being dictated by the evolution of geopolitical risks and their impact on oil and inflation. That's all for now.